Insight, let's go to our featured guest of the morning. He's Gavin Graham, a longtime market professional. He's now with the Income Investor and Internet Wealth Builders newsletters. Gavin, first of all, it's great to have you with us. Thanks again for making time for us today on the program. Why don't we start, Gavin, with the outperformance of the TSX energy shares, despite the collapse in the underlying commodity? What's going on?
Well, mostly, thanks for having me, Paul. And the energy stocks are outperforming energy because they're really, really cheap. Even with oil at $74 a barrel, they're still literally gushing cash and paying it out to shareholders in the form of either special dividends or buybacks, as well as paying down debt hand over fist. So it's one of those situations where the underlying commodity has, as you said, come back very sharply in the last couple of months. But all that's done is just to point out that the energy stocks, which were pretty good value, are still very good value, even if oil were to remain below $80 a barrel. If you take an $80 US West Texas price, then they are going to continue to be enormously profitable, continue to pay down debt, and continue to reward shareholders. So it's unsurprising that energy shares have done a lot better than the price of energy.
What about the price of energy? I don't think anybody saw this coming in September when oil prices looked like they were on their way to $100 US per barrel. And early this year, there were lots of predictions from big investment houses, big Wall Street houses, big Canadian houses, that oil prices would in fact hit $100 US per barrel by late this year. They almost got there, and then they've been into free fall. What's going on?
Well, I think, as you mentioned, the OPEC Plus meeting, which was due to be held last weekend and then got postponed to later this week. There is evidently some disagreement between the Middle East producers and Russia as to whether or not there ought to be more production cuts. Russia needs to continue pumping as much oil and gas as it can, firstly because it's selling it at discounted prices because it can no longer sell it into the European market, but secondly also to fund Mr. Putin's continuing war with Ukraine. At the same time, the Middle East producers might be willing to actually reduce their production to actually keep the price somewhat higher. But if so, they are the ones who are going to have to take the hit, and that may not necessarily be what they want to do. But the major point, I think, Paul, is here we are in late November with minus sort of 5, minus 10, minus 15 temperatures starting to hit, and even in Western Europe. And there's a lot of seasonality in the oil price. We've had a relatively mild autumn. We had a very mild winter last year, which meant we didn't have the catastrophic spikes in energy prices in Europe that lots of people have been expecting. But the fact is, winter is coming, to use a Game of Thrones line, and you are going to get some cold days. And if we actually just have a normal winter, you'll doubtless see higher oil prices because there's going to be more demand for the stuff. We do have an El Nino, which is somewhat milder, but even so, we are going to get a period when oil is traditionally strong going into January, February. And so we may well yet see oil back. One specific point for Canadian producers is when we finally get the pipeline open, Trans Mountain to the West Coast, you're actually going to have another 550, 600,000 barrels of oil from the Western Canadian producers having an outlet. And that's going to, if you believe experts like, I think, Eric Nuttall, who was on last week, you could well see the discount on Western Canadian sedimentary narrow from $25 a barrel to West Texas to maybe $10 to $15 a barrel. So that would be a specific boost for the Canadian producers.
That event is getting very, very close now. It's been investors have been and companies have been waiting for it for years. That's the opening of the Trans Mountain Pipeline expansion project, which would take crude oil from Alberta to the coast of BC for shipment to non-U.S. markets, which would be the dynamic in play that would narrow that discount. The U.S. is currently our only customer, and that's the reason for that huge discount on Western Canadian Select versus West Texas Intermediate crude oil. Do you think that'll be good for the share prices of the big Canadian producers?
Absolutely. And in fact, some of the Canadian producers, people like CNQ, Canadian Natural Resources, for example, are actually doing quite well already, partially because they have non-Western Canadian production as well. But, again, if you're looking at things like Suncor or Imperial or the like, you are seeing that they've held up relatively well compared to the price of oil. And it ought to be a major boost for them, because if you're able to add an extra $10 a barrel to the price of oil, that's obviously going to drop straight through to their bottom line, and that's going to be good news.
Should investors have these shares in their portfolios, and what would you say about portfolio weighting?
Well, again, if you've got the S&P TSX 60 ETF, you've got a 20% weighting in energy already, and obviously that is quite volatile, as we all know, but it's probably not inappropriate, if only because they are very, very cheap. You have the specific Trans Mountain expansion benefit coming through, and in the meantime, you're being paid to wait, because one of the things, Paul, I think, is that you are seeing 4 to 5% dividend yields on some of these. For some of the sort of more sort of gas-exposed names, like, say, Peyto, you're up in the 8-9% yield range. So it does definitely seem as though that you could just go with the neutral weighting that's in the TSX, and that would probably be a pretty sensible exposure to have.
That's Gavin Graham. He's our featured